Thanks, Arun. Good afternoon, ladies and gentlemen. Thank you for being here this afternoon. As Arun said, the theme and topic for our panel over the next hour or so is raising capital from the domestic market. Just to very quickly introduce the panelists, to my extreme left, we have Bharati Jacob, the managing partner from Seedfund. Next to her is Sateesh Andra, managing director from Endiya Partners. We then have Deepak Natraj from Aarin Capital and Sandeep Parekh from Finsec Law. And as Arun mentioned, I'm Abhishek from PwC. Sorry, you can't hear? Sorry. So, between all the panelists, I think it kind of represents pretty much the entire spectrum of both investors in some sense and fund managers. We also have Sandeep, who's a legal expert, and to some extent I can chip in on the tax aspects. So Bharati, if I could start with you in terms of the overall theme of the panel. We've seen a recent trend, at least in 2015, based on the statistics that were thrown up, that the quantum of domestic capital increased sharply compared to the earlier years. I mean, 2014 was the lowest year ever in the last 8-9 years in terms of domestic capital raised. That rose sharply in 2015. Is that just an aberration? Where do you think domestic capital versus foreign capital is? Is it going to overtake it anytime soon, or are we really far away from that?
Yeah, thanks, Abhishek. I think this question on domestic versus overseas LPs takes me back to 2008. But just give me a couple of minutes to share a story. We were close to raising our second fund, and we had all the commitments from primarily overseas investors. I mean, 95% was overseas investors. We were supposed to call for close on the day the terrorist attack happened in Bombay. And my first thought after, feeling terrible about the terrorist attack was our fund won't close now. But I didn't realize how bad it was going to get. A couple of months later, we regrouped with the investors and we looked to call for close. Some of the investors pulled out, and they were substantially American investors. And one of them told me at that time, he said, Bharati, India and Pakistan are eyeball to eyeball. They'll go on war any minute, so I cannot invest in India anymore. And I think that sort of underlied the impact, the reason why we need domestic LPs. Because he pulled out, there's always a herd mentality among investors, not just among the VCs, even among LPs. Everybody else pulled out. And that set us back by 2 years, 2.25 years to be precise. Finally, we closed the fund. It took us another 2 years to close. So I think what that shows, at least showed to me and to all of us, was that we need domestic LPs who understand the local conditions, who understand on the ground what is happening. If you think back to 2009, April onwards, the India economy was doing well. There was the fair bit of domestic demand was still strong. The credit had been unlocked, which had frozen for 6 months post-Lehman. But you didn't have LPs who understood what was happening on the ground. You only had overseas LP who were looking at it through their own lens, which is, maybe a Pakistan tinted lens or China tinted lens, and evaluating India. So I think over the years, I have at least felt a strong need to have domestic LPs just to help us raise the fund. But are we there fully? Do we have sufficient funds? I believe not. I don't think we are there. We don't have a large number of family office or institutions, whether they're endowments or trusts, investing in AIF class, which is really early stage or private equity. There has been a recent resurgence. I mean, there's been certain activity in that space in the recent time, and that I think partly driven by the valuation. Everybody looked at the huge valuations that some of the unicorns have and felt perhaps this is a good class to invest in. Otherwise, I don't think even today you can close a fund of more than 20 million at best or 25 million, with purely domestic money. And that's really a sad state.
Bharati, but if I can just stay with you, and since you talked about your experience going back to your earlier fund, how much of that has changed? I mean, if, let's say, India and Pakistan were to come back eyeball to eyeball, I mean, have people's perceptions changed, or is it really the overall dynamics are still the same, and it's as, the divide is as stark as it was, let's say, 8 years, 9 years back?
I mean, I think we are dehyphenated from Pakistan, but now we are somewhat hyphenated with China. So if something happens in China, then people worry. Or, even if you say India is today the fastest growing economy, and it has structurally, it's a very much stronger economy than China has or will be. But I think it's somewhat hyphenated, perhaps because we, in the LP base, we really don't have strong advocates for India or people who have an interesting understanding. I think all the LP pool has over the years, over the decades, spent a lot more time invested in understanding China, perhaps not so much India. And in China, they have made money. You see, we also haven't performed that well. So we haven't had exits and we haven't performed.
Thanks. Sateesh, your perspective on the domestic versus foreign capital, how do you see it changing? Do you see domestic capital rising dramatically, or will it be a slow curve?
Sure. Yeah, thanks, Abhishek. Like Bharati pointed out, one of the things, I was with a Valley venture fund called DFJ, partly investing in India for DFJ. We used to have this big challenge because both your LPs and sometimes your partners don't look at a local opportunity through the same lens. It becomes very difficult to kind of justify a particular investment thesis in a local deal. At least those days, a lot of things have changed in the last few years. So likewise, not only just the partner's perspective, ocean away, I think even LP's perspective and ocean away is very different. You need to have a good set of local LPs, but that's a big challenge still. The reason is that if you look at the Europe or US LPs, they have all had certain exposure to different asset classes, and venture being the most risky asset class, very high risk, high return, they do buy certain exposure, to that particular asset class. In an Indian context, I feel that still majority of the LPs do not have enough exposure to even the other asset classes to start thinking of venture as an asset class itself. So when you can safely, put money into real estate and get some decent returns, why even go into a venture capital fund is a question that they ask themselves. However, what I've seen is that in the last couple of years, family offices have become very, very active. And especially family offices of successful entrepreneurs who have created value. In our fund, it's evenly distributed, 50% family offices out of our 8 investors, 50% financial institutions. All the 4 family offices are entrepreneurs who have been extremely successful and who have built billion-dollar businesses. So we kind of went after them not only for their money, but also their domain expertise within that particular sector. So things are changing, and I think the government institutions, whether it is SIDBI, it's got India Aspiration Fund. Recently, Department of IT has launched an electronic development fund, and we're talking about Department of Science and Technology that's talking about science startups as well as biotechnology startups. Then, some of the financial institutions like LIC and others are willing to participate. So a handful of active family offices and few financial institutions, like what Bharati pointed out, at best, maybe 5 or 10 funds can probably raise $25 million or $20 million each from the pool of this capital. I think once fund managers like us produce returns and are successful, there'll be case studies, and then more and more money will come into this particular sector, is what I feel.
Thanks, Sateesh. Deepak, do you think Bharati and Sateesh are being very conservative in their estimates?
Okay, I'm going to pick up on what both of them said and put a little context behind this. When we go out and speak to people when we are raising money, this is at Aarin. I'm going to give take a 30-second rewind. Aarin has only 2 LPs, Ranjan Pai and Mohan Pai. Pai is a common surname, they're not brothers. Ranjan's built out the Manipal's for-profit business out of the university. This has got nothing to do with Manipal University. It's the same family, but that's a not-for-profit. So there's a very healthy 16-hospital business that runs. We have very healthy higher education and distance learning business that Ranjan has built out. So he's not kind of, we also have a stem cell research company. Products are coming out for issuance for commercial use soon. It's also a JV with Cipla. So that's one side of a person who's extremely entrepreneurial. Mohandas Pai, you guys see and hear enough about him. He's also got that strong entrepreneurial come operations streak in him, which has brought these two gentlemen together and made a rather interesting family office, which has itchy hands as far as making investments is concerned. We've also got about 7 funds, which covers everything from incubation to a hedge fund. Public markets, pipes, everything. We're into all of those. So we generally get a good spread of the market. What Bharati and Sateesh said is very appropriate, because to an extent, based on the theme, you can or can't raise money. And what we found is, if we look at one of the funds, which is Xfinity, we've had no problem raising money. We raised 125 crores in 3 months. That was in 2014. They're doing their next fund, Fund 2. In the past, it's taken them almost 14 months. They're close to 300 plus crores to raise. The other funds, not all of them are finding it a cakewalk to raise money. Whether it's the team or anything else, that's up to debate, up to question, but that's how it is. So to an extent, there is the theme element, there is the team element, and then there is the timing element. Xfinity is largely finished in the high wave, the wonderful high tide. The others are going in when it's, this is the year of the hangover, right? So they're going in and trying to raise money. Interesting themes that have come across for us are, there is this whole lot of people who, up to, say, late last year, felt they'd missed this entire unicorn wave. So they're willing to look at all these funds with full excitement and cut as many big checks as possible. Papers came out with Rakesh Jhunjhunwala's name. Yes, that is a fact, but how he approached it, what he saw and what that caused in Bombay was a certain kind of behavior. But again, picking up where Sateesh said, family offices generally approach it a little more mature. Right, the SIDBI and the other Electronic Development Fund, etc., are excited. So yes, they want to put in money. You got that huge amount which they don't want to miss out on startups, so they are putting out money. Then when it comes to the retail investor, now I'll again contrast Xfinity Fund 1 with Fund 2. Xfinity 1, which has about 125 crores under its belt, has 60 investors. We consciously went after individuals with 2 and 3 crore checks. The idea was to broad-base the concept of technology. And I'll give you some of the party lines we use because it's good for their understanding. Taking up on 2008, when we look at how the Indian IT sector was built out, and probably, I don't know, $100 billion worth of value, almost the entire value was captured by FIIs. There were hardly any Indian investors. So our pitch was, here is startups, here is such a healthy environment of phenomenal Indian talent, and how is it that the Indian investor is missing out on this? How can you not be a part of this? Take biotech, take pharma, take basic technology, take 4 kids sitting in a garage dropping out of IIT much to their parents' disgust and writing an app. Or somebody who's done Flipkart and Snapdeal before we had the valuation recheck. But when you say that, the whole approach people have taken is, look, I've created, last year was the year of FOMO, right? So last year we created the right FOMO around it. So that's what really worked for us. So from Aarin's standpoint, I'll just, belabor this a little bit. We do med and ed because that's where our background is. That's where our ability to really diligence things well is. So for example, if a medtech idea comes, we actually send it to the hospital, have people look at it and tell us what are the pros and cons. So we take a call whether to invest now or just support them commercially and invest later. Same with education. When it came to other things like core, deep technology, etc., we found teams whom we are comfortable to work with, both from an ethical standpoint, number one. Number two, equally important is the competence standpoint, and we said, yes, we will support them. Of course, there is always the shortage of capital, otherwise I would like to have been LPs in both their funds. And that day will come. So that's how we've seen it. So, I mean, I hope that answers your question.
Thanks, Deepak. You talked about retail investors, and Sandeep, you've had a lot of experience in the financial sector. You've been part of SEBI, and now you're sort of on the outside advising companies. What's the sort of legal framework you're seeing? Is there a barrier from the legal framework perspective that's preventing domestic capital or domestic investors rather from coming in? Is the retail investor adequately protected? What's your perspective on the whole domestic versus foreign debate?
So we've actually been associated with the entire regulations of alternative investment funds nearly 5 years back, when it was at a draft stage, at a concept level stage. We were one of the 35 people or organizations which had sent in the comments, and SEBI in fact decided to rewrite the entire AF regulations to fall in line with market reality, which is, I think, I believe, not just because I was part of SEBI, but I think it's the most open of all regulators. It's open to listening to the market. From there, we've come to very recently, many of you may have at least seen in the newspapers, if you've not read the entire report, the Narayan Murthy Committee report on alternative funds. And if you see the entire report, you'll be really surprised to see that there aren't too many recommendations, except on taxation. So I think instead of a 4-letter word, it's actually a 3-letter word, which is actually killing the domestic fund industry. In particular, the category 3, which is virtually dead on arrival, which is really surprising. In fact, this budget was quite a shocker because the entire category 3 investor community was waiting for the Minister of State who's from their industry to actually see sense and rationalize the taxes. And for those of you who are not very familiar with category 3, it's basically primarily listed. So 50% plus is investment in the listed space. And the contrast is very stark. If I have ₹1 crore, I invest in Infosys or Reliance, after a year I pay 0% capital gains tax. Versus if I invest in a category 3 alternative investment fund, I have to pay a 32% tax. I mean, unless you're bitten by a rabid dog, there's no rational sense for you to actually invest in a domestic fund. So till the time we get this right, till we get the tax right, there's really no reason. I mean, there are things on the margins. We can talk about insurance companies being allowed to invest more, but those things are at the margin. I think there's so much of entrepreneurial passion in India, so much of investment management talent in India, much of which is actually working out of Singapore. So much of domestic capital, which is, we have a very, very high ratio of savings, which is not in investments. We invest in land and gold, unfortunately, not in productive assets. So I think we've got everything right, except for tax. And the choices are too stark. And the proof of the pudding is in the eating it. So if you look at the entire domestic AIF industry put together, it's well below $2 billion. That's probably a couple of minutes on Bombay Stock Exchange, right? So it's a puny industry, and it deserves respect. And I think, Abhishek, you're probably the best place to comment on the tax. So I'll probably ask you to put in your few words as well on this.
No, so Sandeep, you're right. I think the expectation was clear that even the category 3 in fund should be given the pass to. That's not happened. And I think, to me, it's a case, and I know that's part of the Narayan Murthy report, which is, to have more cohesion and understanding between regulators, right? Because I completely agree, SEBI has been very, very receptive in making changes. But I think when it comes to the finance ministry, there is just complete lack of acceptance on the overall format. And I think where the debate really loses focus is when they start looking at all of this as incentives, right? They really need to understand that if they're giving a fund pass through, it is not an incentive. They're really making it as you said, just like an investor would have put money in Infosys, if he's coming through a fund, make it similar. You know, it took many years. Even the pass-through for Cat 1 and Cat 2 didn't come easily. You know, you've known the history. Earlier, it was restricted to specific sectors. You know, then it came up with a lot of conditions. Last year, they came up with a 10% withholding tax, which fortunately is now gone in certain situations. So I think the difficulty from a tax side is the ministry just not understanding the concept. I don't think it's so much a question of the revenue loss, because really the debate here is about a minuscule percentage of domestic investors. All the foreign investors are anyway getting all the treaty benefits and not paying tax. And unless you make it attractive from a tax perspective, it's not really going to work. So I fully agree with you, Sandeep. Sateesh, coming back to you in terms of the experience you had on raising capital from the government's electronics development fund. I know you talked about it briefly, but could you just take us through your experience? I mean, firstly, congrats on that. That's, I think, a very rare achievement. What was the whole experience like? I mean, we went through all the challenges of raising domestic capital, but how did you manage to convince, you know, a government fund in that sense?
No, I think it's quite surprising because it was more an inbound call to me than me reaching out. I don't like to sound arrogant or abrasive when I say that. I think the key is now in some of these institutions, there is expertise, whether it is SIDBI or even EDF and other institutions. They do look for certain asset class or certain type of fund managers. Our fund is focused on technology companies, India's technology startups that are aspiring to go global in the areas of tech, healthcare, and then a little bit of consumer tech. And again, given my background, a lot of it in semiconductors in Silicon Valley, you know, I'd spent time both working for large corporations as well as 8 years as an entrepreneur doing 2 startups. It was more an inbound call saying that they're looking to invest in funds, you know, that are going after certain device technologies, fabless semiconductors, and IoT kind of startups. So it was a very quick dialogue, and they just wanted to make sure that credentials were in alignment with their objective. And once that was very clear, you know, they said they would go ahead and make an investment. But that said, I think the key is for any one of us, whether it's Bharati or me or Deepak being both an LP as well as GP, you know, or when he's investing, making direct investments in some of the startups, I think the challenge still remains, you know, when I go raise my next fund, can I have the same set of LPs come back because I'm able to produce returns and give them good returns? To be able to do that, I think we have to make the right bets, and we all know that it's the 20% of your investments that return capital. I think Bharati was sharing some statistics about their exits, which is fascinating in terms of the number of exits that they've had, more than 1x. So the key for us is really showing. I think majority of the overseas funds, and whether mostly in US, have had the track records. You talk about Fund 10 or Fund 11 or Fund 12. That means they've been doing this for 25, 30 years. So the GPs. So that's the biggest challenge here too. Because if you don't do that, then they lose confidence and you don't have a second chance, or they may think that, you know, this is not the right thing for them to do. And that's a bad thing for other set of investors who are going to follow on.
Sandeep, just staying with this same theme and just to sort of flip this on its head, is there any validity in the debate that you hear that, you know, government should not be using taxpayer money to invest in a risky class? So what's the regulator's perspective on that?
So I think it's the government's perspective, not the regulator's perspective, of course. But I have a little contrarian view. Many people would say that government should not be in the business of the private sector. But let me take you to an analogous area which is not discussed when we talk of all the big NPAs and banks which we talk about all the time, you know, the Kingfisher and all the infrastructure projects which have been much bigger than Kingfisher, which are not talked about at all. The whatever 7 lakh crores worth of NPAs, etc. We forget that the public sector banks actually invested in India. In those sectors when the private sector guys, all the ICICIs never touched those road projects, infrastructure projects. And according to statistical evidence, 1% of India's GDP over the last 10 years, every single year, is because of those investments in infrastructure, which is underappreciated, I think. Similarly, I think, to draw an analogy, I think this is a very high-risk segment. If the government is willing to take the risk, so long as it's not crony capitalism, I would actually be quite happy with the fact that they take this. It's a very difficult political move, frankly, for the government to invest in the private sector. So if they've done it, they have shown the guts to take a high risk, high return investment option for the greater good of the economy. I'm frankly quite happy with it.
Sure. Sure, Bharati.
I'll just add to what, I completely agree with him. At that time, there were a lot of people who wrote articles about the billions of dollars flowing into AIF. And a lot of it was actually, I think, misrepresented, because a lot of it was real estate funds or a few large funds that did private equity investment. And it is a new asset class, and I think fund managers have to perform for them to be able to attract a lot of money. And I think in some ways the government is seeding it, the way it has seeded UTI or LIC or a bunch of other companies. So I think, and I'm fully with Sandeep when he says there should not be crony capitalism. There should be very transparent way of measuring. And I think government should measure how many jobs does this create, because ultimately that is really what the government wants, to create jobs in the country. If you look at the SBIC, which is, I think, Small Business Investment Council in US, which started in 50s or 60s, that really gave birth to the venture fund industry in some senses. And if you go to their website, it clearly says these are the number of jobs we have created. So I think measurement and transparency is very critical in doing this.
Sure. Bharati, just staying with you and sort of changing tracks a little bit, all of you talked, particularly Sateesh talked about how, family offices are a large constituent of his LP base. But today you also see family offices directly making investments. So is it that, are family offices sort of playing on both sides? Are they, functioning as an LP on one side and competing with the PEVCs on the other? How do you see the divide, or is it just one of those things that will settle down at some point and, after you maybe get Deepak's perspective?
I think it's not an Indian phenomenon. A lot of LPs from overseas are also making direct investments in India, as well as I met a couple of family offices in Brussels who are making direct investments. I suspect they don't want to pay the management fee and share the carry, and that's why they're doing the direct investment. But from an, the entrepreneur's perspective, and I'm obviously biased, but I'll still state my position. I think it's better to go to a fund that is doing it, that's the sole reason for existence is doing those early stage investment or doing the growth capital investment. Because as a family office, there is an X percentage that we will invest. They invest. The rest of it is in public markets, in different stuff, in treasury bills or debt instruments or whatever. So I think as an entrepreneur, my suggestion would be go to somebody whose real sole existence depends on making that right investment and making those returns. It is a lot more professional, and I think you do get a lot more support in that sense.
Deepak, is Bharati being biased?
No. There are viewpoints, and that's absolutely legitimate, because now I'll talk about us when I'm in Xfinity or something else. We always have family offices wanting to co-invest without paying carry or management fees. So yes, there is that ailment. I'm not being defensive. I'll talk to you about Aarin. I use only the family's venture money, so I don't know what they do with bonds and other things. So ours is, and the strategic interest is only one, that is to make more money. So that's how we see it. If we look at the ecosystem, I think there's a place for both. Look, we all live and die by our reputations. So if we start acting very funny, either as family offices or as funds, the word goes around. And then people don't want your money even if you have it. Now, the fact that they've invested in so many companies, obviously they're very liked. And people go to them for money. So when they come to us also, they come with the same kind of expectation, expectation. So you don't come to me expecting me to behave the way they do. There is professionalism, there is a way they want to work towards getting exits. So when you have that kind of capital, why would you exactly come to a family office? So I'll give you Aarin's examples, more from our experience. People come to us for a simple need, Manipal. Okay, Manipal hospitals, Manipal University. So if there's an education idea, you're silly if you have not gone to us. If it's a healthcare idea, if you have not gone to us, Reddy's, Max, Fortis, I think you're not doing enough homework as an entrepreneur, regardless of which venture fund you go to. Having said that, we also do a lot of co-invests, Aarin, I'm not talking about the other funds, with the likes of Axel, with the likes of Sequoia. Why? Because they get a certain comfort from engaging with us. So they say, okay, if I have Manipal or you have a Reddy's or you have some, the Apollo Reddy's, not the other Reddy's, you have a certain perspective that's brought in and a certain respect given to the investment. So that's, I mean, it's basically, horses for courses, you do. And I do believe a lot of times, a significant amount of co-investing happens because in its own way, it's all of us working towards creating the same value and the same exit for the company. So, I hope I answered that question.
Sure, but Deepak, just to take that further, and two questions to you. On one hand, you said that really Aarin or your funds are really made up of two LPs, who in a sense both have family offices of their own. So what was the motivation to create a sort of fund format in between? I'm just sort of continuing with the debate on fund versus, or a PEVC versus a family office.
Sure. See, we started out with some casual investing by Ranjan and then Mohan. We said we'll all put it together and do one set of, one consolidated fund. They pool their capital and build a track record. We'll see what that track record is used for, but it's basically building a track record. It's also that they have a part of them that really excitedly wants to invest. And we've got a lot of deals where we've cut the first check. We've had founders walk in and walk out with a check. I'm just kind of, fast forward the time. It doesn't happen that easily every time. But, and then we've had bigger investors come in later. So I don't know, we've never seen a conflict or we've never seen it as a conflict. We've just said that we love investing, we like working with founders, we like working with entrepreneurs, and so we want to back them. So.
And is there a sort of theme or reason? I mean, you talked about having 7 funds. Is that just, broken up by theme, or is there any other story?
They have their own teams, they have their own fund managers, they're all professionally run, they're all AIF registered entities. Aarin is not, because we are what we are, so.
Sandeep, from a regulatory perspective, are there any bottlenecks, that are coming in the way of increasing the pie of domestic capital? We've talked about sort of the business realities and all of those things, but is there something from the regulatory side that's coming in the way?
Not really. I think the only requirement for an AIF is there has to be pooling, and the definition of pooling, the dictionary definition of pooling is more than one. But that can easily be taken care of by one of the employees putting in the minimum capital. So it's not as if family offices cannot set up an AIF, and of course they've done it. So I don't need to belabor the point. The basic theme of AIF regulations, in a single word, is contract, which means everything is left to the law of contract. It's the only law of SEBI which you will find which completely allows conflict of interest. So long as you disclose it, you can do anything you want with your investors. You can charge whatever fees you want. You can charge. You can have a conflicted model in which you're the builder, you're the developer, you're the fund manager. You're on all sides of the equation. So long as you disclose it and you're fair, you fairly disclose it, you're okay. And we've set up several REITs under the AIF structure well before the recent REIT announcements were made. So tax issues apart, I think people have quibbled about a lot of things. And people have said 1 crore is too high. It should be 50 lakhs. It should be 25 lakhs. But those are quibbles. Those are not issues. But because as soon as you reduce from 1 crore to 25 lakhs, automatically the law of contract will go away and the regulatory structure will come in. It will become much more difficult to do business. There will be many more regulations, much more investor protection regulations which will come in. So I think broadly, I think, and you get the same theme from the Narayan Murthy committee report, that there are no real issues for investors, except they've talked about investor classes getting more liberalized, etc.
So just on that, you talked about the 1 crore limit, Sandeep. The Narayan Murthy report talks about a concept of accredited investors instead, where they put an income threshold of 50 lakhs and don't have a ticket size. I'm fully with you that if you reduce it to a very low number, then the regulatory constraints and oversight just become unmanageable. But do you think that's something that will work without putting a number and leaving it to a more informed class of investors? That's a good wire media, do you think? Do you think that will really increase retail participation?
I don't think the end game should be to increase retail participation. The end game should be to minimize retail participation. And when I say retail, I mean they've defined retail. We can define, we can, as I said, it's kind of we can keep arguing till 11 p.m. whether 1 crore is right or 75 lakhs is right. But if you just look at the next comparative number, which is 25 lakhs in the portfolio management scheme, there's a minimum investment which is required. It's much less risky if they invest in, typically invest in listed stocks. So if you ask me personally, I think 1 crore is fairly okay. We can certainly quibble about.
Sateesh?
Yeah, Abhishek, I won't chime in here. I have a very different perspective. I feel, the investors who invest in this asset class have appetite for risk, and they're excited to make an investment. It's not really lowering the threshold. I think we all know that during good times, everybody becomes an angel. There's no angel left in the heaven, right? And during the troubled times, you find it very difficult. Everybody acts very tough. And people think very differently, just the way we talk about, who can be an entrepreneur, and some people never want to pursue the path of entrepreneurship. So likewise, you give money in the hands of a particular investor, they may go put it in real estate or buy gold or put it on an FD, but some others will go invest in a startup. So you cannot engineer that behavior by simply lowering the threshold. So that's one thing. And the other thing I see is that it also depends on the fund manager. There are some people who are very comfortable dealing with large set of retail investors. And there are some people, who say that I cannot deal with so many of them. I want to build a fund with not more than 10 to 12 investors, because you have to manage their expectations and you have to be in sync with them. So while the participation may increase, eventually it comes down to a strategy of a particular fund manager is what I feel.
Yeah, I did see eyebrows go up when Deepak talked about 60 individual investors. So yeah, I agree with you that different fund managers have different themes. But just staying with the Narayan Murthy report, one of the recommendations or one of the themes there is to, allow, for example, Indian charitable institutions. Today under the tax laws, they're not permitted to invest in AIFs. There's a recommendation to increase the limit for banks. There's a recommendation on insurance companies, on pension funds. So do you really think it's a regulation holding back, sources like this, or is it, again, just a maturity issue? Bharati, if we start with you and just go around.
I suspect it's more understanding the space. The whole idea of entrepreneurship and what it means and what it takes to create companies and exit, those are all fairly recent phenomena. And some of the money that a charitable institution might have might need to be, capital might need to be very well protected, in the sense that they don't need huge returns, but they need, they work on capital protection instead of capital multiplication. And it could be, I think, an understanding that may not be there, and that's okay. And it could also be related to regulations. I do believe, in entities like insurance, banks, they should be allowed to, invest a certain limit, up to a certain limit.
Sateesh, your perspective on this?
No, I completely agree. It's more to do with the understanding and appetite, but I firmly believe that it's very difficult for someone to play equally well in 2020 and 50 and a test match. I think there was a private equity panel, they talked about really investing in real businesses as opposed to a lot of venture capital funds investing in hope. So sometimes you get very worried. I think last few years phenomenon when hedge funds were doing Series A investments, the writing was on the wall very clearly, who don't understand entrepreneurship. And very early stages is very difficult. So I just feel that eventually what kind of talent do these LPs have? I think going back to your question previously, what I've seen is some family offices, they do direct investments where they have the domain expertise. And if they have enough deployable capital, they'll bring in a team that manages the money for them because they're still committed to the cause of entrepreneurship. So likewise, I think within all these LP pools, eventually, they have to take almost a 20 to 25-year view of what they're going to do with this capital and then how they're going to generate return and contribute to the cause. So I've had the, whether you call it, fortunate or unfortunate, I was on the board of the bank for 5 years, a mid-sized bank, and I know that there were NPAs and a lot of outstanding, loans or advances going bad, and that's minuscule. I mean, that's a lot bigger than what you would put in a venture capital fund and lose, but still RBI would not allow that, to do that today, right? I think you were talking about priority sector or whatever. So I think it's to do more with the mindset rather than with mechanics is what I feel.
Deepak, your perspective, is it regulation or is it maturity and understanding?
Maturity to an extent, because, VC is here to stay. We have a complex economy, but an extremely entrepreneurial people. Let the track records be set up, let the money be created, let the returns be generated, miss a few. The regulators will fall in place. Opening floodgates now, there is the risk of misuse. So I guess as long as we deliver and we take a long-term view over it, the markets will sort itself out on its own.
Sandeep, your perspective on this?
No, sir. I see it from a completely different lens, which is the political lens. And I think all of us in this room underappreciate the political, the entire optics of allowing these entities to invest in, let's say, AIFs. And those of you, I was part of a law firm in Bombay in 96, 97, and we represented a lot of private equity people, all of whom have vanished because they all sank their money completely. 100% of their money was lost, many of them. Is any government, not just the Indian government, is any government willing to invest their money or insurers' money, which is much worse, in these products? I mean, if I was in the government, I would be very hesitant to allow that. So, I mean, these are all, in the utopian world, certainly we should allow it's commonsensical. 5% is not such a big number. But I think when we talk of those reforms, we ignore the politics of the whole issue.
Sure, but equally, I think there should be no negative regulatory arbitrage. I mean, on one side, while we're saying, we should leave it to the maturity of an investor, it should not equally be prohibited for a charitable institution because ultimately it's about diversifying your investments. So maybe that's the other way to look at it.
No, just to highlight, Sandeep, I think 2 weeks ago, Canadian pension fund bought Snapdeal equity, right? So I'm just saying.
That's actually a very good example of what I'm saying. They're wasting the money.
Yeah, and I mean, and we know what all the pension funds are doing on the real estate side. So yeah, I mean, I think, so, sure. No, I mean, I think the idea is not to discuss specific investments, but I think, I think there is a point of view that it is difficult for the government to encourage people to make so-called risky investments. But, my perspective is equally they shouldn't be prohibited and it should be left to each one's judgment. We'll do a sort of last theme and then open it up to Q&A, which is sort of on the tax side. One of the recommendations, again, in the report is to treat AIFs at par with public market investments. So, any investments that an AIF makes and then when it exits, it should pay a securities transaction tax and there should be no capital gains. Personally, I don't agree with it. I think it's probably asking for too much. So, one, what is your sort of quick view on that? And again, I know Sandeep did talk about tax being a big deterrent, particularly for Cat 3 funds. But overall, do you really see tax as a big deterrent? And do you think the government needs to go so far as to treat it at par with public investments?
No, I don't know a lot about the taxation on the different AIF categories. My only view on tax is, if you have to pay tax, then you're doing really well. So we should all be happy about paying tax.
No comment.
Sandeep, your perspective, is that going too far or is that worthwhile?
I think it's worthwhile for the simple reason foreign investors don't pay capital gains tax. So I mean, why are you forcing Indian investors to pay between 15, 20, whatever, 23% and 35, 30, now close to 35% tax? And the investor's not even sure whether there'll be double tax, whether there'll be passed through. At what stage, it's awful for managers who are taking a 2% fee. If after 10 or 15 years the taxman comes knocking and says, give me 35% tax, where's the manager going to get that money from? So I think the tax uncertainties are horrible, but the end goal should be also that I think foreign investors and Indian investors should be at par, whatever it is. Tax, both of them are 10% flat, I have no problems, but I don't think Indian investors deserve to be treated in a more inferior manner to foreign investors.
Fully agree, and I mean, sort of just changing tracks a little, that's exactly what's happening on the REIT side, because, the treatment given to foreign investors is so starkly beneficial compared to what it is for Indian investors that it probably will be a long wait before we see retail Indian investors coming into the REIT platform. But, with that, let me just open it up for any questions that all of you have. If you can just let us know which panelist you would like to address the question to. Either been very clear or very unclear, but all right. On that note, let me, on behalf of the organizers, thank all of you, Bharati, Sateesh, Deepak, Sandeep. Thank you very much, ladies and gentlemen. Thank you for being patient. Aarin, thank you for having us.